Standard deduction add-on. If you are blind or over age 64, you get to add additional amounts to your standard deduction. So this doesn't do you any good if you're itemizing. It only helps people taking a standard deduction. Now that a married couple could both be blind and both be old, and they would get 4 of these additions. This is also indexed for inflation. These are the 2013 amounts. They are pre-printed at the bottom of group quizzes and tests. Don't forget to use them. 2014, you can see that the single and head of household is getting a little bit larger, but married is not. For every one of these inflation-adjusted items, they each have their own little set of math, the things they look at in the CPI basket. And sometimes one changes, sometimes both change, sometimes none of them change. So don't try to memorize. So let's talk about head of household. You'll note that the head of household had a slightly better standard deduction. It also has better rate schedules than a single person. But married filing joint is always the best status as far as the size of the standard deduction and the width of the brackets. So to be head of a household, you have to have a household, so you have to have a dependent, but not because of the your football buddy or a multiple sport agreement. So it has to be a legitimate situation where it's a qualifying relative and you yourself are providing more than half of the support. So the trick here is that you have to pay more. In addition to paying more than half of the support because they're your dependent, you specifically have to pay more than half of the cost of the household. So that means that's the rent, the maintenance on the house, the electricity bill. And so some people get in trouble because they pay for the food and they pay for the clothing, but the dependent is chipping in on the rent. So you got to make sure that if you were asked by the IRS, you can trace what you are paying to the cost of the household itself. With the exception of the parent, what it says here, the relative must live with you. So Great Aunt Betsy has to be poor, right? Because her gross income has to be less than $3,900. She also has to live with you. Your child, by definition, has to live with you, right? Because a qualifying child must meet the relationship test. So I always tend to make a joke here. The people who write the tax code are just as normal as we are. And the thought of having mom come back home to live with us after 30 years of being independent is just a little bit more than even the most hardened politician can bear. So mom can be in a condo in Florida as long as you are supporting her, paying more than half of her support, and that support is specifically paying for the rent on the condo and the electricity, etc. And with divorced parents, you can get the situation where the custodial parent decides who can claim the dependent. So the one who's not living with the child could be claiming the exemption, but they cannot be head of household because they're not living with the child. So the custodial parent has given up the exemption, so they are claiming only themselves, but because it's their child, they can be head of household. So you can be single with 3 exemptions, you can be head of household with 1 exemption, so don't assume that the number of exemptions will tell you anything about the filing status. Under the abandoned spouse or kick the bum out rule, a married taxpayer could be treated as unmarried for just the purposes of claiming head of household. Married filing separate can cost you a lot of those tax credits that I alluded to when you have a qualifying child. So this is a way around that. Also a way to get a little bit better tax break. So must have a dependent, must have a qualifying child. The child must live with the taxpayer, which is part of the definition of qualifying child. But the spouse must not have lived with the taxpayer. So by July 1, he's either got to have left voluntarily or with a restraining order. If he's still there on July 1 of the tax year, then you cannot be treated as unmarried, and you'll have to choose between married filing separate or married filing joint. Temporary separation does not count, so he's in jail, but you know you love him. He's coming back. You're going to take him back. You cannot file as head of household because you have not either been abandoned nor kicked the bum out. Now we have a set of examples about determining filing status. So I'll let you read the facts here. So to get the filing status, well, dad's not married, so he's either going to be single or head of household. So, and I guess in a sense, you first of all have to decide, does the child qualify as a dependent? So 20-year-old son lives with him, does not pay room and board, so indeed father must be paying more than half of the cost of the household that the son is living with him. But the son is 20 and he's making $8,000, so he can't be a qualifying relative. Can he be a qualifying child? Well, as a full-time student, he can be a qualifying child through year 23, as long as he is not in that last bullet providing more than half of his own support. Remember, you don't count what the kid earned if he socks it away. You only have to count it if he's spending it. So what do you think? Is the child a qualifying child? And if so, should father be single or head of household? Head of household, right? Father's paying more than half of the cost to run the home. The son is living with the father. The son is a dependent because he is a qualifying child. He does not pay more than half of his own support. He is in school, less than age 23 or 24, and he lives with dad. Slightly different set of facts. Note the bold. Never ignore the bold. There's something special about being old for tax purposes. All right, so to get to Lucy's total standard deduction, you first of all have to decide whether she could be filed as single, because remember, just because you're single doesn't mean your filing status is single. She potentially could be head of household. All right, so look at that second bullet, and that second bullet is going to tell you whether or not Lucy can file as head of household. So take a good look and think about it. Yeah, she is a qualifying relative. Not a qualifying relative. She is a member of the household, and a member of the household will not get you to head of household status. The bullet about Ethel, the being 70, is to remind you that the bump for age and blindness belongs only to the taxpayer. So it really doesn't matter how old Ethel is. It's basically useless information. We know that she's single because if she was married filing joint, we'd have to worry more about why she was filing joint, just to get the withholding back or to reduce taxes. Living legally is just a requirement. She is a citizen of the United States. She has income from Social Security. Is Social Security gross income if that's all the income that you have? And hopefully you're going to say, no, it's not, because only people whose incomes are relatively high have to worry about including Social Security and income. So what do we land up with? We land up with single, but we do get a bump for age. And so the total standard deduction for Lucy is $7,600, and she will claim 2 exemptions, right? Her personal exemption and a qualifying relative exemption for Ethel. She meets all the requirements to get the $3,900, but she doesn't meet the requirement to get head of household status. This is the last major topic of Chapter 3. I referred to it as the kitty tax in the menu at the very beginning, but it really applies to anyone who is claimed on somebody else's return. Your mother makes only $3,000 of gross income, and you provide more than half of her support. In all likelihood, you could be claiming her on your tax return. If that's the case, she still has to file a tax return because she has $3,000 worth of gross income, and since she is already claimed on somebody else's return, she does not get her personal exemption, if you remember that from earlier, and her standard deduction is just strange, so she may land up owing some taxes, even though $3,000 doesn't sound like very much money. So the first step is to calculate taxable income. That's the same regardless of your age. The second step is to determine if the kiddie tax applies. Not so much kiddie anymore, since it now applies to anyone who is your dependent who's under age 24. When this tax was originally created, it only applied to children who were under age 14. But as usual, the government needed money, so they kept making the kiddie older and older. So now if you are a qualifying child, you are subject to the kiddie tax. Now remember, this is a tax on your own return, not your parents' return. And then we've got to calculate the tax liability. Mom's tax calculation is pretty much the same as what we've been doing so far. You would look it up in the tax tables, since she clearly has to have less than $3,900 of gross income. And for the child, someone under age 24, you have to use the special rules that are in the following slides. So the first step is, remember, no personal exemption. So taxable income is AGI minus a standard deduction. And I've asterisked the standard deduction because it's strange. I am assuming that the taxpayer does not itemize. It is possible for very rich children to have a lot of investment expenses, but that's Chapter 6 and we haven't gotten there yet. So our children will all be single. They will all use a standard deduction. And remember that they're not going to get the personal exemption. So the standard deduction for this class of people, whether it's your mom or your kid, it is guaranteed to be at least $1,000. It could be as high as a normal standard deduction for a single person, but that depends. So to get larger than $1,000, you must have earned income. Now, when we say earned income here, we mean salary, Schedule C, that kind of income, not the income you earn from having money in the bank. So interest and dividends are what we call unearned income, and wages and Schedule C are what we call earned income. This is an important distinction that can be confusing. So if your earned income, your wages are greater than the $1,000 standard deduction, you get to top up the tank. So for every dollar of salary you have, you can add $1 to the $1,000. If your salary is $6,100, you're done. If it's $7,000, you're done at $6,100. Because remember, for a qualifying child, there is no gross income test. Right? The kid can make tons of money. As long as he does not pay more than half of his own support, you can claim him. So let's say instead of $7,000 of wages, you only had $5,000 worth of wages. Your standard deduction would be just $5,000. But if you have investment income, you can add another $350 to that. That covers people like my daughter, who never made a lot of earned income, but she was just a little saving monster. And so she might have $50 worth of interest income on her tax return. Without the $350 rule, she would have to file a tax return, give the government a check for $5, and it would cost the government probably $50 to process that check. So it's kind of eliminating the nuisance of these people having small amounts of investment income that really don't generate enough revenue to worry about. So the standard deduction of the $6,100 up to plus any increases for age and blindness. And there is an example. You could very well have a mom who's age 70 making $2,000. She would get the bump. You could have a child who was blind but generating earned income from one reason or another, or just investment income, and they would still be entitled to that increase to their standard deduction. So first you test to see whether it's somewhere where it is between $1,000 and $6,100. And then you go back to look and see if they're either old or blind and add to the standard deduction. All right, so this slide reminds us that the kiddie tax, that's the special tax calculation. Everybody calculates taxable income the same, but only the qualifying children have a special tax calculation. And that kiddie can be pretty old, can be as high as 23 years of age, and has unearned income greater than $2,000. And you'll see how that works in just a minute. So if my kid only has $1,000 worth of investment income, this kiddie tax won't actually apply to him. He'll have to run through the math, but he will not pay a higher tax than he would if he was not subject to the kiddie tax. And that $2,000, once again, the asterisk. Remember, the minimum standard deduction for this category is $1,000. So they've simply created this buffer. The first $2,000 of unearned income, all right, that's your interest, your dividends, your capital gains, is free from the kiddie tax. So what that does is it gives parents an opportunity to do some saving in the name of the child, but not huge amounts, right? $100,000 in the bank nowadays will probably not bring in $2,000. So you can start building a college fund without having to pay higher taxes. All right, so before we start this slide, something that I forgot to say earlier, and I'm too lazy to record the slide all over again. The reason why we have this kiddie tax is to prevent bracket shifting. Right? You've already seen 2 instances of bracket shifting, that shifting income that would have been taxed at your highest marginal tax rate to another taxpayer who presumably has lower tax rates. We saw that in tax return 1 by creating a regular corporation and leaving as much income in that regular corporation as Thelma could. She landed up with an extra 15% tax bracket and an extra 25% tax bracket inside the corporation. Monies that by the time we moved to tax return 2 and 3 were being taxed at substantially higher rates. In divorce, you have the option for bracket shifting because the ex-spouse with higher income can make payments to the other spouse in the form of alimony. Alimony is deductible to the person who writes the check, income to the person who receives the check. So if your ex is in a 33% tax bracket and you're in school because he has to support you until you get a college degree, you're probably using the 10 and 15% tax brackets. So by making payments called alimony, they get shifted out of that higher marginal tax rate to be taxed at lower rates. Well, as you can imagine, rich people can afford to give money to their children. Remember, they have to give the property to the child. The assignment of income principle says if you own the property, you own the income. So rich people will set up fancy trusts. From the time they know that a baby is on the way, rich grandma and grandpa are making generous gifts to this trust so that a baby in this lucky bracket could land up with $500,000 worth of principal in a bank account very quickly by the time they are birthed, if you will. And so by giving the property to the child very early, they end up creating lower tax brackets. So now this income would have been taxed, the income on the $500,000 would have been taxed grandma's rate of, say, 33%, and instead the kid gets his 10 and 15% tax brackets. So if the investment income is more than $2,000, you land up not being able to bracket shift on any investment income over that first $2,000. So this slide's a little messy. We've got examples coming up. If it's mom or grandma that's your qualifying relative, you just go ahead and go to the tax tables and look up the tax. If the kiddie tax applies, that means that your dependent, is a qualifying child with more than $2,000 of unearned income. What you're going to do is use the parent's rates for anything that is over that $2,000. Anything that's left will be taxed at the dependent's rate, starting at that 10% marginal tax rate. As I said, this could be confusing, but we've got several examples coming up and you'll see how it works. So the total tax would be the sum of what's at mom's rates plus what's left over taxed at junior's rates.